UnitedHealth Group, stock ticker UNH, is currently trading at $458.49. Year to date, they are down 11.6%, and if we zoom out for the last year, they are roughly even, up 0.5%. During the last week of trading, they took a massive dip based on the fears of higher costs for health insurers. So in this video, I want to take a closer look at the dividend stats of UNH and also calculate the intrinsic value based on our normal spreadsheet. So if we jump right into it and just punch in the ticker UNH and wait for everything to auto-populate here, I am trying to redesign this stock screener so it will be better viewable in the future. But for now, I still have this. So currently the PE non-GAAP forward ratio is 16, which is a bit below the 5-year average. The dividend yield is 1.6%, which has a payout ratio of just under 30%. That is looking pretty good. It is pretty close to a 52-week low, and a 52-week high is 558. The analyst has a target price of 595, so there is room for some upside here, at least according to the analysts. It has an EPS growth rate of 17.4% and a return on equity of 27%. So if we jump into the dividend stats and then zoom in a little bit, I'm trying to go through what I really want to see here. So in the first table, you can see here, we do have the dividend growth rate from the different years, and also we have them calculated based on a 3, 5, and 10-year average. So what I really want to see here is some steady growth over the last year. For example, here they started pretty high with 33%, but now we are around 15 to 10%. Even though the 10-year growth rate is still around 20%, but in the future you might want to look closer if they keep up this level of growth. Also, if it's sustainable, and also if there's a bit of a trap going in here, expecting a high growth rate, and then they start to slow down. Also coming down here, you can see the dividend yield graphs here. At least according to the 5-year dividend yield, we like to see it in the blue here, because according to dividend yield theory, that means that it could be undervalued. Also, the table on the left, or the graph on the left here, says it's around 4% discount at the current time. To support this, we also want to calculate the intrinsic value, so we do have some valuation models. The first one being the discounted cash flow model, where we do take the free cash flow from the different years. We then apply a growth rate to calculate the future free cash flow. Using a discount rate, we then discount the future free cash flow back to a present value, sum all that together, combined with the cash and cash equivalents, the total debt, and the shares outstanding, we arrive at a fair value of $524, sorry. The next model is the dividend discount model, where we do take the dividend payout from the different years. We then calculate a growth rate based on that. And as you can see here, it's been pretty steadily around 14 to 16%, with the average growth rate being just below 15%. We apply a growth rate of, let's say, 10%, even if we've been very conservative. Since the weighted average cost of capital is lower than the growth rate, it gives us an intrinsic value. So I will then be excluding this in the summary later on. The next one is the multiples valuation model, where we do take some companies that are considered peers to UNH. We take their earnings per share and combine it with their PE multiples to arrive at a median PE multiple. We then take the EPS of UnitedHealth and then calculate based on the median a stock price of $414. Next up is the price to earnings variation, where we do take the price to earnings ratio average from the different years. We then average those together, at least the 5 years before. We take the last 12 trailing months EPS worth and then calculate intrinsic value based on that, and that arrives at $448. Next one is the Graham's revised variation model, where we do take the EPS of the company, PE of a growth growth company, a growth rate for UNH into the future, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. We then combine all that together using the formula over here on the left to arrive at an intrinsic value of $419. Next up is the free cash flow valuation. Similar to the PE valuation, we do take the price to free cash flow ratio from the different years. We then take the last 5-year average, combine that with a free cash flow per share, at arriving at an intrinsic value of $542 per share. Last one is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio, combine that using the Peter Lynch formula, which gives us an intrinsic value of $412. Before we go into the summary, let me just take a moment to thank you for watching the video. If you come so far, please subscribe to the channel and like the video. Let's jump into the summary, where we do take all our different valuation models and throw them in here. I did exclude the dividend discount, as you can see it as a negative value, so I did exclude that one. The remaining one gives us an average intrinsic value of $460. The current price being $458, meaning that the current discount is minus 0.4%. 4%, meaning that it's roughly at a fair value right now. So even if we punch in a margin of safety of, let's say, 10%, then we need it to drop a little bit more. But as we've seen the last couple of months and quarters and so on, there is a big chance for this to happen, even though based on the notes that was giving at the Goldman Sachs meeting where we had the drop just after on June 14th. So if you are interested in this company, I do believe it's pretty fair value right now. I will probably wait a little bit more to see if it will go down further. But if you're eager to start a position, I think this is a perfectly good opportunity if you believe in the long-term outlook of the company. Thank you so much for watching, and I'll be seeing you in the next video.